Welcome to the Unbiased Advisor Podcast, where we explore investment themes and insights for investors and financial advisors alike. The views expressed are intended solely for informational purposes and should not be construed as investment advice and are not meant to be a solicitation or recommendation to buy, sell, or hold any securities mentioned. Please stay tuned for additional disclosures at the end of the podcast. Today on episode 3, recorded on February 19th, 2021, we have Aaron Stanhope of O'Shaughnessy Asset Management and author of the Factor Investor Daily Look. We will discuss a blog post Aaron penned titled Why Markets Go Up. I hope you enjoy our discussion with Aaron Stanhope. Welcome to the podcast. Thanks for joining us today. I want to introduce Aaron Stanhope of O'Shaughnessy Asset Management. He is a principal and client portfolio manager. He is also author of the Factor Investor, the New Look or the Daily Look, right, Aaron, is what you call it?
The Daily Look, yep.
The Daily Look that can come to your email address on a daily basis, kind of gives a brief synopsis of what happened in the markets on the previous day. But Aaron, why don't you kind of jump into, your background and how you got to this point that you are right now at O'Shaughnessy?
Yeah, sure. So I guess I been investing for a long time, since like the late 1990s, even when I was in high school, which I guess is kind of dating myself. But I kind of got started in the industry. I worked for a bank that some of you may know called IndyMac, which was in the middle of the mortgage crisis in 2007, and that's actually when I started. It was, I think, June of 2007.
Perfect timing.
Oh, perfect. I had this really great front row seat to watching the mortgage crisis implode. The trading desk was right behind me, couple rows in the cubicles away, and kind of just watched the financial system seize up, which was a great education very early in my career. And I think I may have taken like the third or fourth severance package that came around that was offered. I finally saw the writing on the wall. And I actually ended up working for a firm called Western Asset, big bond shop out in LA. Kind of because of that, I went to go interview, and I think I kind of ingratiated myself to them by talking about these stories of the traders throwing footballs around the trading floor and all this, because they had nothing else to do. And then, so through my fraternity, actually, so I actually worked for my fraternity prior to even working at IndyMac. And there were some partners at O'Shaughnessy Asset Management, still there to this day, that kind of connected through this kind of, we call it the past staff network for SIGEP was the fraternity. And they were looking for someone to kind of fill like a client service type role. And so I started with O'Shaughnessy in 2010 and kind of gradually worked my way through and sit on the research and portfolio management team now. Just basically trying to educate clients about what's going on in the markets and kind of framing our strategies within that context.
That's great. You're at a great shop. I know those guys do a lot of great research, and they put out a lot of good stuff. Patrick also has a podcast that's really great. And then I know you guys also team up with some of those research blind research guys. Jesse Livermore, I think, writes through you guys and stuff like that. So you guys put out a lot of good stuff and a lot of educational stuff. So I really appreciate that. And to investors that are listening to this, you want to check that out. It's a great resource to learn about investing, really, in general. So the reason I got you on today, Aaron, is I ran across a blog that you wrote, I think, almost over a year and a half ago, called Why Markets Go Up. And I think this is a question that a lot of advisors and investors in general just kind of take for granted, right? I mean, everybody's seen that, historical stock market chart that shows, large cap growth, stock or small caps, and then treasury bills and the dollar or whatever. And there's just this line that goes straight up over time. But nobody's really kind of, in my opinion, explained exactly why that holds. Because if you look at Japan, for example, they had a 30-year, I think, if I'm correct, I think last week or this week, they just finally reached that 30-year peak So 30 years of just going sideways, basically, which is crazy, right? So I remember when I was coming out of college and getting into the field, like I was searching for the answer to this thing, as to, what to tell clients of why the market went up. And just on a personal note, basically what I came up with was like, we live in a consumerist society, and like consumers always just want to buy stuff. We're always trying to keep up with the Joneses. So we're always kind of enticed or, behaviorally wanting to buy more and more stuff. And so I thought that was the reason that these companies that are listed on the market, that's why they keep kind of moving up. Interestingly, I did read Jeremy Siegel's book, Stocks for the Long Run. I kind of scanned that to see if he would give a more mathematical approach as to why stocks go up. He didn't really attack it that much. He, again, kind of went with the historical route. And so I want to talk about your paper, which is available on your blog, which is at factorinvestor.com, called Why Do Markets Go Up? And, the first thing you kind of attack in there is the general axiom that everybody kind of throws out there. Well, I'll let you explain the general, I call it ex post axiom that everybody looks at, but you want to talk about that for a second, Aaron?
Yeah. So the axiom really is that you've sort of got your equity return, which is kind of in the 10%-ish range over time. And when you really think about it, it can be broken down into just three components. So the first is earnings growth. The second is dividends. And the third is what we refer to as multiple expansion, which most people know it as like the price to earnings ratio. It goes up and it goes down. But over time, it's actually kind of flat. It's kind of around 15 is the average. But like in the 70s, it was in single digits. In the 2000s, it was close to 30. Now we're getting kind of close to that number again. So it fluctuates. But you can kind of break down equity market returns into those three sort of key buckets.
Right, right. And so, looking at that formula, so to say, you can obviously figure out what the dividend yield is, right? To kind of forecast going forward. Multiple expansion, as you put in the paper, and as quite a lot of research has shown, it kind of mean reverts over the long run, right? Towards whatever that 15 and a half level. And as you said, right now we're kind of on the top end. Now, when that happens, though, there's always these arguments that come out that we're at a new higher plateau of price to earnings, or what have you. But the one part of that axiom that's always kind of tripped me up, and what I think you did really well in the paper in explaining, is that earnings growth portion, right? Like, my question has always been like, well, why do earnings grow? Like, could they not go negative over a long period of time? Why is it that earnings in a mathematical framework or a logical framework continue to grow in the US in particular? And I'm going to, I want you to kind of break that down if you could. That's the bulk of your paper. And I want you to kind of explain how you attach earnings growth, or how you explain that earnings growth portion of the axiom.
Yeah. So if you think about like the market cap of a company, so the market cap of any given company is really the present value of the sum of all the cash flows that the company is going to produce in the future. And so there's really kind of like two components of that. There's sort of what they're producing now. So let's just assume they produce, let's say, $1 per share on to infinity. But then there's this component of like, what's the growth on top of their current business? So that's really key. That's the earnings growth portion, because if it were just the value of the continuing business, earnings growth would obviously be zero. Multiples wouldn't expand over time, and you just sort of be flat, except for the dividend yield. And so it's really this component of growth into the future. Now, when I was in grad school, one of my professors brought up like a really interesting point, which is that, most people assume that things grow to infinity, but the reality is that almost every company in the United States historically has gone out of business.
Yep.
A lot of them last, less than 5 years, but then, there really aren't many that last more than 50 or 30 or whatever it is. So a lot of people kind of make the assumption of inflation for companies in general growing into infinity. That's actually not a really great assumption. But the thing that does make it reality is when you think of the market as like a portfolio of businesses, not a portfolio of stocks, a portfolio of businesses. And when you're an allocator or a manager of a business, you kind of have a couple like key roles. So number one, generate profits from your existing business, but then you've got to take those profits and reallocate them into the business. It turns out that's like really kind of the key piece. You can acquire other businesses, you can start other businesses, basically anything an entrepreneur would do effectively. So what ends up happening is in the marketplace as a whole, the underlying companies themselves change, businesses grow and they die, but it's that reallocation of capital that's so important, that's a key component. And the best way to see it is in terms of dividends, is when you think of the growth of earnings really back to 1871, and I kind of touch on this in the paper. It's around like 4%.
Yep.
Let's just say around it. But when you look at the reinvestment of dividends, it's like 4.5% in terms of the contribution to that total 10%-ish return for stocks. Well, why is that? It's because companies that pay dividends tend to be more mature in their life cycle. They're redistributing capital that is going to companies that don't pay dividends, which tend to be higher growth companies that are plowing those cash flows back into their business. So it's sort of key that there's this redistribution that's going on a long time as well. And, then you can kind of dive into like what is actually driving from an economic perspective that earnings growth also, which is kind of was one of the most interesting things for me to kind of think about.
Sure. Yeah, that's a great synopsis. So you framed it as, you don't look at an individual company as far as the stock market is concerned. It's a conglomerate of all these companies, right? And the dividends that get paid out by the more mature companies oftentimes will get kind of reinvested back into these startups or higher growth companies, and that's kind of what's generating a component of that return. And then now the economic perspective you also have in there. Can you talk about that?
Yeah. So what kind of got me thinking about this was kind of two things. So I've always been fascinated by Ray Dalio's process, and he put up a paper. This is like years ago, before they really had anything on their website. Was his paper, The Economic Machine, and in it he kind of, I would say that his career and the lineage of his writing and everything is kind of that intersection of economics and markets. Sure. Which I find fascinating because really a lot of people actually don't do that. Like Peter Lynch is an example. One Up on Wall Street said years ago, if you spend more than like 5 minutes on economics, you've wasted 5 minutes or something like that. And I think that's the approach that most people in the equity space take. Whether it's right or wrong is, up for grabs. But I found that paper, How the Economic Machine Works, to be like quite fascinating. And then a couple years ago, you mentioned our research partners. One of them, who goes by the pseudonym Jesse Livermore, wrote a paper called Factors from Scratch, which is this like really intense technical breakdown for like why value and momentum and other factors work, which is a fascinating read, but not for everyone. One of the things that I took away from it was sort of this process that he created to basically break down returns into these differing components, and sort of this axiom that we referred to before around how do you break down that total return and say, 4% came from earnings growth and 4% from this and a couple percent from multiple expansion or whatever it is. So I started thinking about kind of like these two things together and thought, all right, well, I wonder what would happen if I look at like GDP growth and compare that to, let's say, like earnings growth for the S&P 500, because it should kind of be similar. We know that like large public companies produce the vast majority of earnings in the economy. So this should kind of work. And so then I kind of started looking at some of the, again, the Dalio research, which in the Economic Machine, he talks a lot about productivity growth over time. And then you kind of parlay that to like Schumpeter, which is all about sort of like entrepreneurial endeavors and what drive those. Is it something like value creation through a new technology, or just kind of like continued efficiency, like a new iPhone that works better than the previous one or something like that? And so it turns out that you can actually break down earnings growth into kind of like two simple components. Real earnings growth. When you look at nominal earnings growth, you've got to add inflation back.
Inflation, yep.
But for real earnings growth, it's growth in productivity over time. And really, it's kind of like from classical economics, it's all about capital. But I think the greatest proxy for that is really just labor. How is the labor force growing over time? And so sure enough, since World War II, you can kind of back into the earnings growth of the S&P 500 into those two components over time, which is just, I find it to be kind of like really fascinating. Really can't do it at like the individual stock level. But
Yeah.
again, it's this concept of a portfolio and an economy where everything's being reallocated over time as companies live and companies die, and et cetera.
Yeah. So, yeah, I don't know if you're familiar with Chris Brightman he's at Research Affiliates. I think he's the CIO there. He had a paper maybe 5 or 6 years ago, and his kind of way he got to is roughly the same way that you did. But he primarily used, which you do too. On the productivity side, he used GDP per capita, right? And that was kind of his marker, so to say, to forecast earnings growth going forward, right? And so you've added the other nuance of labor, which can probably be kind of somewhat predicted ahead of time, right? By looking at birth and death rates, demographics, stuff like that, labor participation and stuff like that. So the question then becomes, it's in my mind, then it becomes, okay, now you have to kind of figure out productivity growth, right? Going forward.
Yep.
And do you find that to be fairly stable over time, or is that something you think you can, is there a better mousetrap to try and figure out whether, are we going into an era of higher productivity growth, or are we going into an era of muted productivity growth? Have you looked at that?
Productivity is actually like, it's the hardest component, because to your point about labor, you can look at reports from the Bureau of Labor Statistics and things like that for how the labor force is going to grow. It turns out to be a really important component. So productivity, kind of in the classical economic sense, they refer to it as factor productivity. And actually what it is it's a residual for kind of like what can't be explained historically by all the other, labor and capital that's input into the system.
Yeah, TFP, I think, right? Total factor productivity, right? Yeah,
exactly.
It's a residual.
So nobody, right? It's a residual. That's what it is. It's literally the unexplained component, and nobody knows. So kind of the best proxy is if you look back to the early 20th century and you just do a regression and a trend line on GDP per capita, it's kind of around 1.9, 2%, which if you think of just all the stuff that's happened over that period, so obviously 2 world wars, other wars, was a great book by Reinhardt and Rogoff on the 8 Centuries of Financial Folly, which talks about all of the EM crises after World War II, the internet boom, automobiles, all this. And it's still kind of stable. High inflation regimes in the 1970s, low inflation regimes like we're living through now. So I think it's kind of like it's a good long-term projection.
Sure.
I think that, from some of our other research, another paper that our co-CIO put out, Chris Meredith, called Value is Dead, Long Live Value, looks at kind of like technological cycles over time. And one of the things that we find is that, which is what we're experiencing now, what's driving the stock market right now is a handful of stocks that have basically captured markets. They're using technology platforms are their business. And at some point that technology diffuses through the rest of the economy. We haven't gotten to that point yet. We're certainly seeing it. I mean, we're on Zoom right now. Like that's a really great example that didn't exist a couple of years ago. Thank God there was no pandemic 5 years ago. We wouldn't have all these phone calls.
For sure.
And so I think at some point over the next, it could be this decade, probably will be this decade, is that technology becomes kind of like commoditized and dispersed through the economy. And that's where you really actually get the biggest productivity boost. So if you're a believer of that and you say, well, the labor force over the next 10 years, it's kind of predicted to grow about 0.5%. To your point, it's very, very predictable unless birth death rates change rapidly in the next few years. If you say productivity is going to go at 2%, so you tack it onto that. So you're kind of looking at like 2.5% total return for equities. You add on that a 2% dividend yield, and then you add on top of that inflation, you can kind of get an estimate for what equity returns should be over the next like decade or so. But if you get an upside surprise on productivity, and let's say maybe it goes 3-4%, you could be in for some, much better than historic equity returns.
Sure.
Yeah.
Okay, that's great. Now, have you, one of the other questions that pops up in my mind, looking at all these papers is why, or I don't know if you've looked at it, does this kind of equation or axiom transfer over to international markets or EM in particular, right? Like I always, we have a lot of, investment houses come in and pitch about EM, because of the labor component, right? Like younger labor force, more people coming in, capital starting to grow in, et cetera. But it seems like in my mind, I look at EM as like a play on the dollar, right? Like when the dollar strengthens, EM sells off and vice versa. So I don't know, have you been able to kind of translate this framework into the international, or have you looked at it at all? Japan, India, whatever it is, basically.
Yeah, so I think that it does translate. I think a lot of these are kind of like first principle type things that I do think kind of pervade through. So part of the challenge with the EM is just a lack of data to be able to look at it. The US is just the easiest. We have the FRED, database that everybody has access to for economic data. It makes it so easy. And then, well, to be fair too, I have access to like the underlying stock data for like the S&P 500 and all that.
Sure.
So it's kind of, you need the data to be able to do it. And there's less of it that's available outside the US. But I think kind of sort of like a key thing also is, I think it's easy to point to like the predictable stuff, like the growth of the population and things like that you mentioned. And those are certainly positives for other parts of the globe. There are other things that kind of come into play too, that are really important. So like property rights, rule of law, work ethic, child labor law, like all sorts of things like that come into play. In addition to your point, currencies are much more important outside the US than they are in the US. Right. So that's like a whole other factor to deal with. And since a lot of those countries have some sort of a peg to the dollar, that really complicates a lot of the relationships. You mentioned earlier about Japan. Japan just had a massive asset liquidity bubble.
Yes.
That popped in 1990. And so everything since then is skewed by that. Like as an example, so we do tons of factor research. Momentum doesn't work really well in Japan when you look at it historically, but it's because the market was in a downtrend for 3 decades. So there are kind of nuances that exist everywhere. And I do think it's fair to say like, so EM is tough to look at as more of a category. It's really,
individualized.
Right. Individual countries.
Right. Because everybody's got different property rights, to your point, different currency exposures, work ethic, demographics. So yeah, it probably is a little bit tougher, but I was just wondering, again, we've been pitched EM for, I don't know, 10 years probably at this point. And it just, to me, it seems to just be the inverse of whatever the dollar's doing on a daily basis, essentially.
What's interesting about EM, I've been looking at this recently, is the composition of just the EM universe is changing a lot. It's a lot more tech and consumer heavy in the last, let's say, like even 5 to 7 years.
Okay.
Than it has been in the past. And like energy and materials are kind of coming down in importance. So I think that at some point in the next like 5 to 10 years, that could be changing, where it's not, maybe not necessarily the relationship that you mentioned with the dollar, but I think that the relationship to commodities within EM is changing.
it was a commodity driven asset class. No? Yes.
Yes.
Okay. So
Yeah.
you're saying it's going to break from that a little bit going forward because the composition is going more like we are here, where it's, you're tech heavy, consumer staple type of stuff, basically, is what you're saying. Correct?
Exactly.
Yeah.
Exactly.
Very good. Very good. Well, do you have any other specific notes you want to hit on that blog that I read? I really, again, wanted to tie down that earnings growth piece because I feel like that's, and you put it in your first paragraph, like everybody talks about the axiom, I call it, right? But nobody actually talks about the why, right? Like, why does this happen? Everybody, it's kind of an ex post theory that's out there, but I really appreciated that. But do you have any other kind of final comments on there before I kind of peg you with a couple personal questions?
I think outside of that, look, like I come from a long only equity shop, so we're just bullish by nature. But I know that a lot of people kind of think like, all-time highs, I need to take some off the table. Maybe that's true. Maybe it's not. But I do think over time markets do tend to trend up, and I think there's a lot of research that says that that's substantiated.
Yeah, I think a lot of people worry. I feel like the 2000s is past. 2000 was a decade of no equity return, but I feel like the consensus is past that. Like they're not really worried about that anymore. But I still run across clients that are still somewhat worried about equity valuations and stuff like that, and are kind of skittish about entering the markets. But again, that's why I wanted to have a mathematical framework or some type of framework to explain in the long run this is how it works. And I think one of the things that's great about your guys' shop is you guys think long term, right? Like we've gotten into this era of well, what was your performance over the last quarter or last year, and then that's it, right? Like everybody looks at the most recent performance without really evaluating the long-term trends, basically. So I appreciate that. So kind of just to wrap up, Aaron, I asked my guests two specific questions. One is, what's piquing your interest right now? What's keeping your attention, whether it's like a podcast or a show or a book that you're reading? You got anything outside of I know you got young kids, right? They take up a lot of time, but is there anything else that kind of captures your attention right now?
At the moment, that's kind of like my pastime, my second job.
The kids?
Unfortunately, yeah, the kids. That's kind of it.
Yeah.
Bunch of good Netflix shows, but that's about it for right now. I'm looking forward to like getting back on the golf course and all that fun stuff.
Are you a big golfer?
I used to be.
Okay. Yeah. Well, you gotta let the thaw happen first before you get out
Right.
there, right?
Exactly.
Yeah. And then the second question I got for you before I let you go, Aaron, is there, you kind of talked about it in the beginning a little bit, but is there a book or a mentor that you have or a class that you took that kind of colors your overall view of the markets?
There's probably a bunch. I don't think I'm not like a mentor in the classic sense, but I love anything by like some of the legendary macro investors, Soros, Druckenmiller, Ed Thorpe, not necessarily macro, but certainly up there. And then people that are kind of really good in niches. So like Jim Chanos is a really interesting one, dedicated short seller.
Yeah.
I mentioned Dalio, Swenson, people that are kind of groundbreakers within whatever space. Howard Marks is another really interesting one. Obviously, Jim O'Shaughnessy has been tremendously influential just because I work with him on a day-to-day basis.
You did read his book, right?
I did. Okay. I did before the interview. Yeah, I sure did. That's good. I mean, from our shop, I obviously get the quant side, so it's kind of like whenever I read, some of these other guys. Paul Tudor Jones also, who are like kind of making trades. Like we all say that they're shooting from the hip. They're probably not. Like they've got their process.
Yeah.
But it doesn't really work for me. So, from Jim and Chris Meredith and the rest of the team, it's all about kind of like this discipline and how can we systematize and make these rules around these interconnections that we see in markets, whether it's stocks to bonds or bonds to commodities or currencies. It's all connected. It's all lattice work. I just find all that really fascinating.
Yeah, again, that's one of the things I appreciate of your shop is you don't really, I would say, break away from your process, right? Like, because you kind of realize that in the long run it's going to mesh out essentially and come back around, because I did a lot of factor research and stuff like that, and what I've come to find is that there's all these regime changes that happen, and factors don't work in certain regimes, but to call those out ahead of time is very difficult. So you just kind of got to stick with your guns, basically your process, and it'll eventually come out, assuming it's based on good work, right? Good research, which again, you guys do quite a bit of. So, well, hey, Aaron, I appreciate all the time today. I won't keep you that much longer, but thanks for coming on. Can you go ahead and plug your website or the subscription, the daily look that you have?
Yeah. So it's just factorinvestor.com. Put out a daily piece, try to keep it under a couple hundred words. So it's a quick 5-minute read, but just what's going on with the markets, thinking about multiple asset classes. I think a lot of people are kind of focused on whatever their niche is, whether it's stocks or commodities or bonds or whatever. So it's kind of great to see the full picture. And every now and then I drop in some research that either we're doing or I'm doing on something kind of more in depth.
That's great. Thanks, Aaron. I appreciate it.
Yeah, of course. Thanks for having me.
This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting professionals before engaging in any transactions. Securities and investment advisory services offered through Woodbury Financial Services, member FINRA SIPC. Woodbury Financial Services is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Woodbury Financial. Past performance is not a guarantee of future results. Information presented herein is for discussion on illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Views expressed are as of the date of the recording based on the information available at that time and may change based on market and other conditions. Although certain information has been obtained from sources believed to be reliable, we do not guarantee its accuracy, completeness, or fairness. We have relied upon and assumed without independent verification the accuracy and completeness of all information available from public sources. Aaron Stanhope and O'Shaughnessy Asset Management, Engage Financial, and Woodbury Financial Services are unaffiliated. Investing involves risk. Loss, including loss of principal, may occur. No investment strategy can guarantee positive results. Investors should be aware that investing based upon strategies or models does not assure a profit or guarantee against loss. This material contains forward-looking statements and projections. There are no guarantees that these results will be achieved. It is our goal to help investors by identifying changing market conditions. However, investors should be aware that no investment advisor can accurately predict all of the changes that may occur in the market. Krishna Patel, CFA, is an investment advisor representative at Woodbury Financial Services and can be reached at 317-489-3505 or kpatel@engagefingroup.com and located at 11622 North Michigan Road, Zionsville, Indiana 46077.